How many of you have heard about FAANG stocks? I guess most of you would have heard about them because they have become very popular all over the world. But do you know who coined the term FAANG stocks? In 2013, CNBC Mad Money host Jim Cramer coined the term FAANG stocks. This list basically included Facebook, Amazon, Netflix, and Google. Now, why would this list include only 4 names? Because at that time in 2013, these stocks were doing extraordinarily well. Google had grown 6 to 7 times in 10 years. Amazon had grown almost 10 times in 10 years. Netflix grew at an extraordinary rate of 40 times in 10 years. And Facebook was a little kid with 2x growth in 1 year since its IPO and looking unstoppable. Yes, Apple was not part of this initial list of FAANG stocks. Later, we saw Apple growing at a very fast rate, and everyone added another A to make it FAANG stocks. Unfortunately, later Microsoft could not be added as it was not fitting well into the acronym of FAANG. I guess they could have made it FAANG, but that sounds more like an Indian acronym. Anyways, let's not get into naming the acronym. Today, these FAANG stocks have a total market cap of $6 trillion plus. That is more than 4 lakh crore, with Facebook contributing $876 billion, Apple contributing $2.1 trillion, Amazon contributing $1.6 trillion, Netflix contributing $242 billion, and Google contributing $1.5 trillion. Just to give you an idea, the entire GDP of India is $3 trillion. So these 5 companies have a total market cap of more than double the Indian economy. If you look at the growth in last 5 years, Facebook has grown almost 9 to 10 times in last 9 years. Amazon has grown 17 times in last 10 years. Apple has grown 10 times in last 10 years. Netflix has grown 16 times in last 10 years, and Google has grown 10 times. And they have become the biggest tech giants of the world. That has generated a huge interest among Indian investors to explore the options of investment in the US market. Hello everyone, my name is Sahil and this is my Personal Finance Academy where I explain everything about money management in layman's language. Recently I conducted a poll and asked how many of you invest in US stocks. I got more than 15,000 votes and here are the results. 25% people said that they invest in US stocks, and within that 21% invest via mutual fund and 4% invest directly. So there are 75% people who still do not invest in US stocks. And within that, 49% said that they want to invest in US stock directly but don't know how to do it. Clearly, there is a high interest among investors to know more about investment in US stocks. So I have divided this video in 3 parts. Before you invest your money, you should know the basic knowledge about the US stock market. So in the first part, we will cover what is US stock market, and then why you should invest in US stock, and finally how to invest in the US stock market. Alright, let's get started. Just like we have Sensex, Nifty as the most popular index in India, US also has various indices. There are 3 key indexes that you should be aware of. First is Dow Jones. Dow Jones is a stock exchange that measures the performance of top 30 companies listed in the US stock market. So you can say that Dow Jones is the Sensex of US. So that's 136-year-old. Comparatively, Sensex was established in 1986. That's almost after 101 years. Second is Nasdaq. Nasdaq represents all the companies that trade on Nasdaq. There are around 3,300 companies that are listed on Nasdaq. As of March 15, 2020, the industry weights of the Nasdaq Composite Index individual securities are as follows. Technology has a weightage of 48.4%, consumer services has 19.4%, healthcare has 10.2%, financials at 7.2%, industrial has 6.8%, consumer good has 5.5%, and then rest is utility, telecommunication, and oil and gas and basis material. If we break Nasdaq, we have a popular index of Nasdaq 100 that would track the top 100 listed companies of Nasdaq. This index is more skewed towards technology stock that represent around more than 50% weightage in the index. For example, Apple has a current weight of 10.9%. Microsoft has a weight of 9.6%. Amazon has a weightage of 8.3%. Tesla has a weightage of 4.2%. Facebook has a weightage of 3.8%. And Alphabet, that is the parent company of Google, has a total weightage of 7.1%. Third index is S&P 500. S&P 500 is a tracker of top 500 companies in US. It is more popular as it represents a broader index. Information technology include 27.6%, healthcare has 13.4% weightage, consumer discretionary has 12.7%, communication services has 10.79%, financials has 10.34%, industrial has 8.47% weightage, and then rest is consumer staple, utility, materials, real estate, and energy. Now let's try to understand why you should invest in US market. First reason is diversification. Diversification is a very important strategy in investment. You don't want to keep all your eggs in a single basket. We have already covered how you can diversify your investment in India across mutual fund, stocks, gold, etc. So we won't get into that. But think this way, due to any reason, if the Indian economy tank or crash, then what can you do about it? For example, how many of you are aware about the hyperinflation in Venezuela? So hyperinflation is a state where the currency loses its value to an extent that it becomes worthless. For example, during hyperinflation, a toilet paper in Venezuela would cost 2.4 million bolivar, the currency of Venezuela. And that's a stack of 1000 bolivar notes weighing 2.6 kg. Just imagine. What if something like this happens in India where a packet of milk costs you rupees 5 lakh? Well, this is a hypothetical example. Indian economy is fundamentally strong and I hope we never face such situation in India. But there is always a risk with investment in a single economy. What if we get into a war with our neighbor and that could impact our economic situation? Even though there is a slight risk, but that can be avoided by diversification in global market. Hence, it makes sense to invest in the US market. Second reason is investment in world leaders, especially in technology domain. Today, who doesn't use Google? Who doesn't use Amazon? Who doesn't use Facebook, Instagram, WhatsApp, etc.? Now, when you invest in such great companies, you become a part owner in the company, although a minute part owner. But you get a chance to become a shareholder of the world's biggest companies. So next time your friend uses Google or Instagram or WhatsApp, you can benefit from it. Third reason is currency appreciation. When you invest in the US stock market, not only you get the benefit of increase in stock price, you also get the benefit of US dollar currency appreciation. For example, if you invest rupees 1 lakh in US stock and they fetch you a 50% return in the next 3 years, then you will get 1.5 lakh. But let's say you invested when the USD to INR rate was around 73. And after 3 years, if that rate becomes, let's say, 78, then you will get the benefit of rupees 5 currency appreciation per dollar. Just to give you an idea, 10 years ago, USD to INR rates were 53. So $1 would fetch rupees 53 10 years ago and today it is 73. That's an increase of 37% in the currency itself. Fourth reason is fractional ownership. Interestingly, when you invest in the US market, you can hold shares in fraction. For example, if Amazon share price today is $3,300, now that is around 2.4 lakh rupee per share. So if you want to buy one share of Amazon, you would need to shell out rupees 2.4 lakh. Obviously, that's not possible for an average Indian. But you can buy shares in fraction in US. So if you have rupees 100, then also you can invest in Amazon share. Isn't it interesting? Unfortunately, that's not possible in the Indian stock market. Now that we have discussed the US market and why it makes sense to invest in the US market, the biggest question is how to invest in the US market. So broadly, you have two options. First option is indirect investment and second option is direct investment. So what is indirect investment? Indirect investment is done via mutual funds or ETF. Again, there are two things that you need to consider for indirect investment. Do you want a complete exposure in the US stock or limited exposure? For example, if you want complete exposure, then you have mutual funds like Motilal Oswal S&P 500, that is an index-based mutual fund that simply replicates S&P 500 index of the US. Then you have funds like Motilal Oswal Nasdaq 100 that replicates Nasdaq 100 index. So with these index fund, you will get a complete exposure in the US market, but that would be based on index. For example, if Amazon has 5% allocation in S&P 500, then out of rupees 100, 5% would be allocated to Amazon. The fund manager can't change this allocation to 10%. Then you can have second option, which is active mutual funds that provide limited exposure in the US stocks. For example, Parag Parikh long-term equity fund has around 30% exposure in US stock and rest in Indian stock. So out of rupees 100, 30% would be allocated in US stocks. Likewise, you have excess growth opportunity that has around 22% allocation in US stocks. Then you have multiple other mutual funds that have some of the other exposure in US stocks, but these two are my personal favorite. Then you also have an ETF to invest in the US stocks. ETF is like an index-based mutual fund, but it can be traded like a stock. So you can buy or sell an ETF during an active trading hour like a normal stock. You have Motilal Oswal Nasdaq 100 ETF in this category. Please note that when you invest in US stock market via mutual fund or ETF, you end up paying a cost that is also known as expense ratio. This expense ratio would vary from mutual fund to mutual fund and ETF to ETF. Next is direct investment. The problem with US based mutual fund and ETF is that it doesn't allow you to choose the US stock where you want to invest. For example, let's say you want to invest only in the shares of Amazon or Google. This can only be done if you invest directly in the US stocks. Obviously, it gives you the convenience to choose the US stock as per your requirement, and you don't need to depend upon anyone. But before you invest in US stock directly, please note that you end up investing via a third party, which is a partner who is a broker in the US. So every company till date that provides an option to invest in the US market directly in India has partnered with a US broker, and you invest via that route. Moreover, you have to pay charges on transfer and withdrawal of money from your bank account to the US partner account. So make sure that you are aware about those charges before investing directly in the US market. Now, there are multiple options to invest directly. For example, you have companies like Winvista, Webull, Stockle, Kuvera, Vested, etc. But I use the app InMoney. Reason being that it is a multi-purpose app for me that helps me keep a track of my investment, and I also use it to invest my money in the US stock. My friend recommended this app and I found it very simple and easy. Moreover, I found that there is no account opening fee with InMoney, whereas the majority of other apps were charging money on account opening. And I was looking for a simple interface where I can easily invest within a few clicks. It just took me 2 minutes to create the account, find my favorite US stock and invest. It was a seamless experience. The best part is that there is no brokerage on using InMoney, and it also provides support with US tax related queries. Hence, I opted for this app. So in this video, we discussed in detail about the US stock market and why it makes sense to diversify your money in the US stock, along with how to invest in US stocks. I am sure that you would have many doubts regarding US investment, and you might also want to know in detail about the step-by-step process to know how to invest in US stocks directly. If yes, do let me know in the comments, and I will try to make another video to solve your doubts regarding how to invest in the US market directly. Till then, take care.